some guys might panic. Maybe they're not likely to hit their promote. Say, okay, I got to just pull the ripcord and get out of this. Our perspective is no. We're going to hold this through the cycle, wait for this, things to come back, and maximize value as best we can in that way. So I think that's where I think the biggest difference is between family offices and other investors in real estate is just that time frame.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig, and with me as always is John Cohen. How you doing, bud?
We're good. By the time this airs, it was just Father's Day. We actually finally had some people over.
There you go.
Just families. It was nice to sit in the backyard, barbecue, have some fun.
Great weather.
Forgot what that was like because we've been stuck in our rooms for the last 3 months. But
exactly.
No, it was good. We're doing good, hanging in there.
Yeah, no, couldn't have asked for any better weather up in Long Island. So it was nice. It was a good weekend, good day. We did similar thing, but just ordered in. So it was good. But was this your first or second Father's Day? I forget.
Second. I had people saying, happy first Father's Day. I'm like, well, I'll take it. What the hell? But no, it was.
I knew it was close, but I couldn't quite remember.
Yeah, the first one, she was like 3 months old, so it doesn't really count.
Gotcha. So this one's a little bit better.
Exactly.
Did you get you anything good?
I got a coffee mug with pictures on it.
That's nice. I'm sure she picked it out herself.
She did a great job. Already more creative than I am.
Right. Well, that's not a high bar. So
exactly.
Yeah, exactly. But awesome. Let's dive into today's episode. We got a really great guest on today. I'm really excited to pick his brain, learn more about him, his company, his business, and everything, because it's a little bit of a different lens to the real estate world. Coming from the family office side. So really excited to hear kind of his take on a lot of things. So with that being said, Billy, thanks for joining us.
Thanks for having me, guys, and belated Happy Father's Day to John.
Thank you very much.
Yeah. So you want to kick us off just a couple minutes, tell everybody a little bit about yourself, who you are, where you're from, your background, stuff like that.
Sure. So I grew up on Staten Island, so the New York market is hometown for me. Went to Penn, then went to Barclays, did investment banking for 4 or 5 years. Then I came over to Partners Path, it'll be 5 years this fall. So we're a family office based in New York. We work for 4 core families, who most of them made their money on Wall Street. So we're really their real estate investment vehicle. We also do some sports stuff, as well, but 90% of what we do is real estate. And that's in 2 different business lines. In Brooklyn and Queens, locally, we own and operate small mixed-use multifamily buildings ourselves. And then in other markets and asset classes, we look to partner with an operator who's on the ground taking care of day-to-day management. And in that function, we're really just a co-GP or anchor capital partner to help smaller operators scale their operations. Usually they're at that point where they've been passing the hat, doing the friends and family, a lot of small checks raises. And we find that we help them bridge to that more institutional raise. It allows them to either cut larger checks or cut more smaller checks in a more efficient basis. Because for a lot of operators, managing the investors becomes a huge time suck, and it keeps them away from where they really make money, which is, finding deals, closing deals, managing the assets. So that's largely what we do, in that, call it $2 to $7 million check range.
Awesome. So I don't want to spend too much time on explaining stuff, but just very quickly for anybody that isn't listening that maybe has never heard the term family office before, can you just explain kind of what it is, what the purpose of it is, something like that, just very quickly?
Yeah. So there's a saying in the family office community: when you've met one family office, you've met one family office. Similar to hedge funds, it's kind of a catch-all phrase, where the underlying vehicle can do a lot of different things. Family offices are largely for a family that has a wealth threshold that crosses more into almost an institutional level, and so it requires a full-time staff or investment professionals who are out there managing their investments, sourcing their investments for them. But what that means can be anything. We focus on real estate. There are other ones that really only play in the public markets. There's other ones that are pure VC, venture capital or private equity vehicles. So yeah, it's kind of one of those tough things where you can say, well, this is what a family office is, but it can present itself in a variety of fashions.
Yeah, I know when I first learned about it, I didn't fully understand it. And when I kind of explain to people now, I basically try to say, just reverse engineer, imagine if you were worth, tens of millions or hundreds of millions of dollars. Would you prefer to pay fees to all these other different institutions, or would you prefer to spend, a couple $100,000, several $100,000, maybe millions of dollars, depending upon how big you are, and have your own staff that is going to have your best interests at heart, making investment decisions for you? Because, there's so many people that make money in oil or Wall Street or real estate, and they want to diversify into other things, and you don't have the time or the know-how to go into different avenues. So you just hire people to do it for you, same like any other company. And I've found when I've kind of reverse engineered it for people, it makes a little bit more sense. But like you said, there's so many different avenues to go into, whether it's real estate, infrastructure, public markets. I'm sure there's so many other alternative things. Like you said, you guys dabble in something with sports. There's so many different ventures and so many different ways to structure it. And then even within the structure, some is just one family, like you guys, some are multiple families. I think there's also businesses that will take on families as clients and act as like larger family offices. So yeah, it's a blanket statement for, a very broad brush. So it's always interesting to hear the different things involved. So being in the family office world and working for, individuals or families, do you see that there's a different way that they take a look at investing in a broad stroke than maybe some other ways? Or is it kind of, similar to, how John and I would look at an investment?
Well, I think largely the biggest difference between, I think, family offices and other investors, particularly in the real estate space, is time. Family offices are looking at this as how do I pass my wealth on to the next generation? So we're not wed to a 5-year, 7-year, 10-year, even 2 or 3 year time frame for an investment. In our ideal case, this is something we could hold for 20, 30 years. And so that flexibility, one, it allows us to see longer term value plays if they exist. Maybe it's land banking or some other, long tenor investment that, either a fund or an operator would say, I want to see my promote back much sooner than that. Mm-hmm. And so, and it also gives us the flexibility with investments where if we get into something in 3 years, so let's say we did something 3 years ago, and now this is when we were going to look to sell and we hit COVID. Some guys might panic, maybe they're not likely to hit their promote, say, okay, I got to just pull the ripcord and get out of this. Our perspective is no, we're going to hold this through the cycle, wait for this, things to come back, and maximize value as best we can in that way. So I think that's where I think the biggest difference is between family offices and other investors in real estate is just that time frame.
Do you find then, because you said you invest with other operators, do you sometimes find it's tough to find good alignment of interest with operators, or not so much, just because if it's a different kind of lens or viewpoint, do you feel that it's not always easy? Because like you said, operators like us, the bulk of our money comes when, we hit certain hurdles and profit sharing and stuff like that. Do you find sometimes it's tough to find that right alignment?
Well, I guess the key for us is that we try to make every relationship a multi-investment, programmatic. And so, for example, we had one investment where 18 months into what we expect to be a 5 to 7 year hold, we'd execute on the business plan, and someone made an unsolicited bid at that point at what we expected to sell it 5 or 7 years from now. And so our partner came to us and was like, "Hey, let's sell. This is going to be a nice check for me." And, honestly, we would have rather, and in all our deals, we have some control rights over sale. And so, in this instance, our investors probably would have preferred that we hold it, refi out the money, hold it forever. But in this case, we've done 7 or 8 deals with this partner. And so in order to keep that relationship going well, and, he did his job, he executed, right? He deserves to get paid for that. So we sold that asset, even though, if it had just been us, we probably would have just refied. And so in that respect, I think if you're looking at these relationships that are long term, you have to balance all of those different factors. And, in some cases you're going to sell to help your partner. In other cases, you're going to hold it forever because that's where actually the most value is going to come out of it.
Yeah, I think that's so interesting. The give and take, doing something that maybe isn't in your best interest to keep that relationship for the long term. I bet there's a lot of people who probably don't think that way and think just on a one-to-one deal basis, and not, if we do right by somebody today, in 10 years from now, when we feel a little bit more strongly, maybe they'll do right by us, or hopefully they'll do right by us. So I think that's definitely interesting. One thing I've also always thought about too, when you guys, because you guys own, a lot in, the New York City area, and you guys are the operators of these properties as well. And then you invest with other operators in other areas, and you give up a decent amount of control. Like you said, you still have some rights or voting rights for major decisions. So refinance, sale, I'm sure there's dollar amounts on budget changes. How do you guys view those opportunities differently? Is there stricter underwriting for deals with other operators? Are you looking for higher returns? Is there something that makes you choose a local investment over something in another market? How do you look at the two?
So, locally, I think we're willing to take a slightly lower return, mostly because we're driving the truck, so we feel comfortable with that. And also it's in New York, which we view as a very well insulated market. So, COVID's effect on it, notwithstanding. And, when it comes to other markets, we're really looking at long-term, what do we think of this market? And also, what do we think of this operator, right? Is this somebody who 5-10 years from now, we want to have done 10, 15, 20 deals with? Right. And so it's the balance of a variety of things, the individual thesis for this deal, the likelihood of more deals falling behind it with a similar thesis, and then just the general, this market, and does this operator have good infrastructure within that market? But we definitely do, for the New York stuff that we're the operator, we definitely feel more comfort, and we'll thus probably take a slightly lower return on those deals. Gotcha.
And do you think that's because the low return, is that just because it's New York and because it's in higher demand, you would expect a low return, or is it because you guys retain full control that you're okay with the low return, or blend of both?
It's probably largely the first, right? Just because how crazy cap rates have been in New York. I mean, frankly, we haven't really done that. We've done maybe 2 or 3 deals in the last 2 or 3 years on the acquisition side in New York. So it's definitely been slow because we've been just waiting out the market. Obviously, the market hasn't come to us all that much. It has a little bit, but it's largely because politicians have made it so that it's less attractive to own in New York. But yeah, I think it's largely just a product of low cap rates in New York. When we see those cap rates in other markets, it really turns us off because a lot of these other markets don't have the same drivers and supply limitations that New York has.
That's an interesting thing. I have that argument all the time when, brokers or whoever brings us deals, sellers, brokers, individuals that come across those, send us, I'll tell what kind of cap rate do you buy? I always say it's a stupid question / that means you're asking for something ridiculous. If you're going to sell me a 4 cap, I can go buy that in my backyard. I don't need to go to fill in the blank, unless it's LA or Miami, and that's different. But it's funny when someone else that's buying deals in New York says that. It's like you're not as crazy as you sound sometimes, because sometimes I get like the biggest cold shoulder when guys, it's a 4 cap, a 4.5, or a 5 cap, and we've sold deals at sub 5 caps, so I can't complain. But when the deal gets brought to me, I scratch my head. I'm like, historically, blank, whatever, whatever state, those are not 4-cap markets. So it doesn't work. So when someone else is looking at it from the same set of glasses, it makes you, okay, you're not as crazy as you look.
Well, I think a lot of that is, particularly on the broker end of things, a lot of people haven't been in the business long enough to have seen what a downturn looks like, right? So they look at certain markets, and I won't cast aspersions to certain markets, but prices have rallied, they're doing great, and that happens every good economic cycle, right? And then what happens at the end of it is they crash, right? People either move away or they can't afford the higher rents, right? Or people just overbuild in these markets where there's very limited zoning restrictions, right? When times are good, everyone thinks that their ground up deal makes a lot of sense, and then they go and they build a ton of them, and then they overbuild, and then people lose a lot of money and prices go back down, and it's a cycle, right? And I think that there definitely are markets right now where you're seeing 4-handle or low 5-handle cap rates that they're overbuilt, they're oversupplied. During a recession, they'll get hurt. Those cap rates will go back up where they belong. Somewhere probably in the 7s. Right now, it'll be where the opportunity is.
Yep.
But the reality is that while I'm saying that on one side, if interest rates remain low, right, real estate's largely an interest rate spread play, right? So if I can borrow at a 2-handle, right, well, now maybe I can justify these lower cap rates. And basically, I'm kicking the can down the road that, if I lock in 5-7 year debt, well, yeah, maybe in 5 or 7 years, I'll have trouble refining that. Or, my asset will be worth a lot less than I bought it for. But in the meantime, I got 5 or 7 years of good cash flow. And so that's the calculus that I think buyers have to do when they're trying to make that decision.
So because we've kind of been leading into this with everything going on, with the pandemic, and today's June 23rd for anybody listening. What have you guys been seeing in, the New York City market? What have you guys been seeing in the real estate market? How have you guys been viewing this? Is it still too early to really understand? Do you see, buying opportunities? Do you see valuations being hurt?
I mean, I think we probably went through a similar progression as most people. I think, in early March, when everything started to shut down, I think everybody panicked and went, okay, wait, how much liquidity do we have at these assets? How do we stress test it? Can we, what if no one pays rent next month? Mm-hmm. Fortunately, I think as most owners have found, people are paying rent. Our collections are probably 90+% so far. And so from that perspective, I think a lot of people who are owners who may be over-levered may not be getting the rent that they expected. Lenders have been really forgiving. So these first 3 to 6 months, it seems like nobody really has any trouble. Everyone's just kind of, I think there are people who probably had trouble in February. Mm-hmm. And now, because of all the forgiveness that's going on, they're able to kind of keep kicking the can down the road and holding on to their assets. So on our side, we haven't seen a ton of action. I think we do a fair amount of bridge lending. And so I think in April, May, we started to see some deals come through just because either equity flaked on deals, lenders changed their terms or walked away from the deal. And so we were able to step in and help people close deals that they were hard on a deposit. So that's where we've been the most active. I think that, we get inbounds from people where I think sellers are starting to, all right, where is this clear today? What kind of pricing can I get? Because I think they see that when my forgiveness or whatever kind of allowances I've gotten from my lender, when those expire, or if the government programs at the end of July don't get renewed, right? Where does the economy go from there? Or a second wave, right? So there's a lot of uncertainty, and I think that it's really just leading to not a lot of transactions, at least from what I've seen.
Well, that's
buyers want a huge haircut, and sellers are willing to give it.
That's what I was the interesting thing, right? It's at this point in time, and I've been saying this for a while. If a seller goes to market with a deal, from my perspective as a buyer, I look at that saying, okay, what's wrong with this, right? He's not selling it because it's humming along operating, it's going to be a couple things. He knows that he's fucked, and it's not going to work if stimulus checks run out, if they don't renew it. He says, okay, this isn't going to happen. Or he says, oh shit, I got to get out now. So when a buyer looks at a deal that's listed or blasted out, you scratch your head and you said, how could a broker get a hold of that and honestly look that seller in the eye and say, I'm going to get you top dollar here? Because I don't think the buyers are out in full force now. Now, with that being said, I do think a deal is a deal, but the bid and ask spread has been off for us, for a while, right? We're not buying 15, 20 deals a year. We're buying 3, maybe 4. And our bid and ask has been off for quite some time now. And even more so now where, okay, if I'm underwriting this deal and I'm looking at this deal, what's my rent growth? What's my delinquency? What's my concessions? Like before I was conservative, now I have to add an extra level in there. It's like, okay, if I wasn't close before, what's going to change? And that's the thing that, that's the interesting part of the market right now from my perspective. It's like, okay, who's the first seller that's going to say, fuck it, I'm out, babe, get my debt off the table, right? And that's when things are going to start being interesting. But even at that point, you're like, okay, what can go wrong here, right? Well, I'm buying it at 65% of its value. Okay, I feel good about that. But there are a lot of people over the last 12 to 18 months that have 80, 90% LTVs that, I hope nothing happens bad to anybody, because that'd be foolish to, wish ill will on somebody. But in the end of the day, those are the deals that are going to have some struggles. If you put good debt on your property, you probably be okay. And, or you can sell it and you could dictate what's going on. But a deal comes out to market now, brokers lie on a good day. Now you have to ask the question even more. So now you say, okay, well, what's wrong with this, right? Why can't he get his number? Or did he do the renovation he said? And you have to ask yourself more questions. And I think that's the part of the market that, that's why those spreads are getting a little bit wider, because buyers want deals and sellers aren't ready to give them up yet, because fundamentally nothing's changed except for nobody's working. And a lot of people are making more money than they were. So it's like, okay, nobody's working and making more money. Those aren't good fundamentals. So it's going to be interesting to see what happens. When someone else says it, it's like, okay, everybody's thinking this way. Who's going to be different, right? Who's going to say, no, this market's fundamental. I'm going in at 5 caps or whatever they are. And that person's either going to make a lot of money or lose a lot of money. And it's going to be interesting to see what happens.
Well, and a lot of this is happening at the top of the cycle, right? So if you look back the last 10 years, rent growth every year has been strong, right? And people are pushing and pushing more, assuming in a lot of cases that growth continues for their personal income. And so now when the air comes out of the balloon, when you look to underwrite your deals, right, your rent growth assumptions now have to change. Your delinquency, as you said, has to change. Your vacancy has to change, right? And I think people were getting very accustomed to underwriting deals, assuming everything goes perfectly. And now it's a big change when you start saying, well, everything could go wrong. And that change in value at the low cap rates that we're playing at, I think this is another thing that, I kind of take from a fixed income investment banking background where, the lower your cap rate is, the more every basis point matters, right? And so when you're at a 5 cap, that 100 basis points to a 6 cap, right, is about 20%, give or take, right? 4 to 5 is about
25.
Right, it's just like every 100 basis points you go up, it becomes less meaningful, but every 100 basis points you're down, it becomes more meaningful. And I think we're at a very low base from a cap rate perspective, and we're also at very high rent assumptions. People are really chiseling away at their expense assumptions and their vacancy and their delinquency assumptions to try to close deals. And most operators, right, they want to be buying, right? And so they're trying to make the numbers print, and they have made them print over the last 10 years. But now in order to insulate themselves, they're making a massive about face. And I think values are going to, or at least should, as long as, people are rational, should see a hit. But that's the music keeps playing, people keep dancing.
Well, 100%. And that's the thing that, when I look at it the same perspective, and forget the cap rates and forget that. I look at it from the income perspective, right? Easy math, 10 restaurants, 6 of them go out of business, 4 restaurants left. Now you have 10 restaurant worth of employees for 4 operating restaurants. So now you take the other 6 people or 6 groups of people that are unemployed. They were qualified at 3 times income. but now they're unemployed, and now their unemployment check is it's 50% of their rent, or maybe even 60% of their rent, or whatever the math comes out to be. So how does that person afford rent, food, shelter, clothes for his kids, school for his kids? How does that person afford it over the next 6, 12, 18, 24 months? Because unemployment may be, massive, and it may get cut in half quickly when people's jobs come back, but there's still going to be a level of unemployment where these people are going to struggle getting jobs, or they're going to struggle putting it together, and now their income is gone. So if their income's gone and their unemployment's less than what they expect, if there's 2 people unemployed, okay, it's a little bit better, but that goes to the same basis. You buy a 4 cap, you don't have much wiggle room for a mistake. Your tenant qualifies. If he loses his job, how fast can he find another one? And if it's supply and demand on the employment side, right? You don't want to buy in a market that's got a lot of building and no demand. Same thing on the employment side. If there's a lot of employers and not a lot of, employees, okay, that's great. People can find jobs. But if there's less employees or employers and more employees, now they can pick the best of the best. Or the employer says, okay, this job's a $35,000 job. Who wants it? You can sort of dictate different things. And that's going to be an interesting component for mistakes, whether, tenants can afford it or not. They might have looked really good 6 months ago and they may not now. So, when you factor that in, all of those other levers start, what's my vacancy? What's my delinquency? What's all that stuff? And that's something that there's just no proof out there yet. So right now it's just, it's my assessment of risk. And I think that's another major layer that will unfold itself. Not only cap rates and interest rates, because interest rates can go to 0 and cap rates can go to 2. You're still getting a good spread. Unfortunately, if your tenants can't afford to live in those properties, it doesn't matter what your spread is, because your vacancy is 50%.
Yeah, I mean, I think one thing that I've been more tuned to now when, we see applications come in for apartments is you're actually looking at people's savings, right? And, there's tons of data out there about how, the average American couldn't sustain, a new large expense, or, the amount of months of operating expenses effectively for their household that they have is very low. And so, if it were high, right, people could, potentially be unemployed for a bit and they can bridge that gap. But without savings, right, the rubber hits the road a lot more quickly. But one thing we have seen, which is interesting in parts of Brooklyn, is right, these hot, trendy neighborhoods, like Bushwick, let's say, where there's a lot of roommate shares. I think a lot of tenants are now saying, well, I don't need to go to an office. This rent is kind of high. If I have a job, if I don't have a job, right, if I was a waiter, a bartender, a lot of those tenants are just moving back in with their parents in order to save money, just wait until their employment comes back. And so I think you could see the air come out of the balloon in some of those markets where, I mean, even personally, I have an apartment in Manhattan, but I have no need to be there. Right. The reason I live there is easy commute to the office, which I'm not going to right now. Or, access to, friends and social things, which aren't happening right now. So it's even had me reconsider, right, is, depending on when we have to be back in an office, like, well, where do I want to live in the meantime? It may not be my very small apartment in Manhattan. And so you might see, I think you've read articles about it. I don't know how quickly it happens, but, the suburbs and more spacious areas definitely seem more appealing in the current moment. Whether that lasts is a question I don't think anybody has the answer to.
Yeah, I mean, I got out of there, right away back in March. So it's the same thing. And I know so many people that did the exact same thing. I mean, basically all of my friends and anybody that could afford to leave and had some elsewhere to go got out as quickly as they could. And basically anybody that had to stay because they had to or didn't have a place to go or didn't have the means to, they stayed. And it's exactly what you said. There's, I was back in Brooklyn 2 weeks ago and it's just a ghost town. I mean, everything's closed, everything's boarded up. There's like no cars on the roads parked, and there's just so few people out and about on it was a Saturday. And I mean, it was gorgeous out and there's just nobody outside. So yeah, I can see, New York stuff getting hit a lot. And especially like you said, in the more, A class, B class areas where people have that ability to either move home with parents, or to just, rent a place for the summer or get out or find something else. Yeah, I'm sure those places got crushed. I saw something that said like New York City overall had like a 34% increase in available leases from like May this year to May last year, or it was June or something like that. I mean, if that doesn't tell you that people aren't signing new leases in the area, I don't know what will. I mean, that's a drastic increase. Are you guys seeing that in your own properties at all? Has that been affecting you guys?
I've actually been pleasantly surprised. We've had a pretty high rate of renewals. People have left. Fortunate for us, have largely been ground floor units, which have backyard space. And so those units have kind of flown off the shelf. I think there's a lot of people who live in Brooklyn go, oh, wait, instead of living in my second or third floor walk up, I can go move to this ground floor one, have a backyard. I don't have to kind of pass through other people's spaces to get outside. So in that regard, we've been lucky. I think, it's definitely, these last few weeks are usually prime leasing season in those markets. And it's felt more like a March or April, where, you see action, there's people coming through on tours, but not the steady stream of just, you lease it, you put a unit up on Street Easy and it's leased the next day. So, it definitely shows that people are less interested in living in Brooklyn in the immediate. But I think really the question is when do we get over the hump of COVID, right? And I don't think anybody has a good guess as to when that is. That's when I think you'll start to see people move back in mass. Those, bartending and waiter jobs will come back. People will be back in offices. Those people being back in offices helps tons of businesses reopen. Our offices in Dumbo, I don't know what, there's residential people in Dumbo, but from a tourism and office perspective, I don't know what the deli and the places we get lunch at. Those are businesses that are, likely shuttered until we get past this. And so I think until, I think the economics of it and the health factor of it are inextricably linked. So until we get COVID under control in a way in which people feel safe to get on the subway and do these things that used to be, March 5th was commonplace and now seems like you're entering a war zone of some kind where you have to have your mask on and constantly thinking about every move you make. Until we solve that problem, I don't see how we get back to normalcy.
Do you see any long-term effects from major urban cities like New York, LA, Miami, Chicago, Boston?
I think it's probably too early to tell. I think the thing that when I was at Barclays, I did a lot of municipal bond work. I think the finances of these cities is going to be very important. Right? They need to find a way to continue to create a dynamic, safe, urban environment for people who want to live there. Because the worst thing they can do is that they cut services in a way that now people don't want to live in the city. And, I'm not predicting this, but the worst case scenario is the 70s and 80s in New York, right? If people do flee for the suburbs, you could, put a lot of these cities have tons of debt, right? You could put them into some kind of vicious cycle where they have to raise taxes enough or cut services to pay debt service and other things. But, with less revenue coming in because less people live there, right? So I think I don't think that's very likely. But I think it's good to frame, the goalposts. What's the worst case scenario? What's the best case scenario? And then you can kind of figure out where the bell curve is in between. So, if I was, a big city mayor, I think, the key is focusing on that budget and keeping services in place as best as you can without, bankrupting the city. I do think that people who, are kind of, our age, right? Kind of in that, like John, you have, your first kid, right? The suburbs look really appealing, right? I think a lot of people in this age range were planning for, I'm always going to live in the city, right? I want to have that lifestyle. I think now people are really going to check that. Not that pandemics are likely to be a regular thing, but I think, the fact that one just happened, people are going to definitely consider it more.
It's the equalizer.
I think, yeah, people who are on the margin, I think, may lean more suburbs than urban. But the convenience factor is too. I think it's too high, right, for it to materially change. I think you might see certain neighborhoods change their vibe. So a place that used to be where you have your first kid in the city, maybe those people moved to the suburbs a little earlier, and now you have kind of younger demographic who moved in to those neighborhoods. But I can't foresee some massive sea change for now. Everybody works from home. It just seems.
No.
I think right now it seems like everyone's like, oh, look how easy this is, but it's easy for a few months, right? When you start hiring new people who you've never worked in an office with, and you have no interpersonal relationship with, it's really hard to work remotely in that scenario. So I think as this plays out over a longer time frame, I think people will reconsider how great working from home is.
So I agree. Like, what happened, it's an equalizer, but at the same time, I agree with that, right? I mean, it's not, it can't work. I talk to people all the time, and I got to get back to the office, right? Like it's fresh in our heads right now, and that's what everyone's thinking about. But you're right. I think it's the people on the margin that this may push over the top, but the bulk, the majority, like anything else, people are still think they're invincible, right? I know people that are going on 3-week vacations and they're still living their life like nothing's going on. But at the same time, I also know a handful of people that are, no, I'm never doing this again. I'm never doing that again. So I think the two extremes, they'll still do their thing. It's just the people that were marginal saying, okay, maybe it's time to settle down. Maybe it's time, hey, we've been together for long enough. We're married. Now it's time to find a house. But that's such a small percentage of the masses. I think over time heals all wounds, like anything else. And listen, as long as there's not another pandemic in 6 months, which I don't think is going to happen, maybe cases come back a little bit because people are out and about. But I think it equalizes a little bit. It just sets the foundation because, home ownership was going down and millennials were, living in small apartments, and that may just get shifted a touch. It's not going to be, life altering where no one's going to live in an apartment building anymore. But at the same time, I do think it'll bring it back to normal or historic normal levels where it's just been historically low everything. It may shift. And that's the cards that I'm playing, right? Can I make an argument that the world's coming to an end? Of course, anyone can. Can I make an argument that, it's nothing's going to change and everyone's going to live exactly how they were? Yeah, you can. But, when I sit about it and I think about it and I think about it logically, I think it just brings it back to, to square one, right? It's like, okay, let's get a little bit more normal and then we'll figure it out. Now, nobody knows, me, you, or anybody, we all can make predictions, but I think it is important to understand, the financial climate of big cities and stuff like that. Because that stuff, if it gets a little crazy, that's when shit happens. But for the most part, if there's good fundamentals, it should go back to close to what it was with a little skew.
Yeah, I think what's been interesting is to hear people compare it to 2001, with the, terrorist attacks in New York City and how basically it changed everybody's perception of the city from what I've heard. Obviously, I was far too young, but, people, even Don said people didn't want the top floor anymore in office buildings. They wanted to be lower down. But because, to your point of, is this a one-off virus or is it going to be, multiple viruses? If this is just one-off and it ends after 3, 6, 9, 12 months, we as a people have relatively short-term memories and will kind of adjust back to where we were. There will be some, holdover. I don't think it'll completely change, and I don't think it'll go completely back to where we were. So whether that's increased working from home, whether it's more people living in the suburbs, I think there'll be some trends that come out of it. But, to your point, I don't think it's going to be a mass exodus or anything like that. I wouldn't be shocked, though, if more people decide to move away from the New York area. We've already seen basically a flat population growth or even slightly negative, I think. This could be one of those tipping things. It's like, most people stay for, the city, their family, or their job. And now if you can work from home or the pandemic frightens you too much, you might decide to make a change. So, I think if this is a one-off event, I wouldn't be shocked if similar to what happened back then happens again, where, just takes some time. But, like you're both saying, we'll kind of go back to similar to what it was, if not exactly what it was.
Yeah, I mean, I think, if you just think about when the last pandemic that people reference, right, it's 1918, 1919, then you had the roaring 20s, right? It's not like people,
Mhm.
went, and became recluses in the woods. Right. So I think, people's memory is short. I mean, if you just think about where the real estate market is today versus where it was in '09,
Mhm.
right? I mean, it's no different, right? People 2 years from now, if this passes quickly, we'll just move on to the next thing, and right, this will be behind us, and things will go back to how it was in February. And people will look back and think, wow, look how crazy everybody got about that virus, right? It was terrible, but it wasn't that big of a deal. Like, but in the moment, people were scared, and when people get scared, they react more strongly and don't think as rationally. So the key is just keeping calm and looking at the data and assessing it as level-headed as you can.
100%.
Absolutely. I do want to ask a question because I'm sure, a ton of people that are listening to this either, eventually want to work with groups like yourself, are in the process of being operators or are operators or just starting to get into real estate and may think about it. What are some of the things that you look for? And maybe even passive investors can, take some advice from you too. What are some things that you look for when you're looking for other operators to invest alongside with?
Sure. Yeah, I think one thing that we definitely like is some kind of track record or pedigree. So that can be one of two things. Either you've already been doing deals on your own and you can demonstrate, look, I know what I'm doing. We've executed a couple of times. This is kind of the deals we've done. The other is that you're coming out of a real estate shop or a PE fund, right? And operationally what one of those big firms is like, the controls you have to have in place and the diligence and that process. So I think the people we've invested with are kind of in those two camps where, they've been working at a big fund and they're coming out and doing their own thing, and we're happy to kind of get them started on that front. The other is someone who says, look, I've done 3 deals. I'm really having trouble kind of bridging from doing these 3 small deals, finding basically new investors for the 4th until I sell my first deal. Right. And that becomes a tough cycle for people to get out of. So having a partner like us come in and inject that capital can really be helpful to them. We really like it when the property management is either done in-house or something that the partner at least aspires to. Otherwise, largely the person's doing something that I could do from my desk here in New York. And so then the value to us just seems a little lower where, I always find it funny. We'll be at a conference and we'll meet somebody and they're like, I'm really active in Sacramento. And I'm like, oh, like, where do you live in Sacramento? Like, no, we're in Midtown. And I'm like, oh, like, how are you sourcing the deals? How are you getting into the market? It just seems a difficult thing to achieve remotely. So we really like people who are in the market, living it day to day. That's how you find those truly off-market deals. If you're sitting in New York, you're getting off-market just in Sacramento. Really, it's highly unlikely, I guess, unless you've already, unless you've done 5 or 6 deals there and have a real track record. I think that those are the main things that we look for. We want people who are going to live and breathe market in the assets. I think that's kind of the main thing that we're looking for in partners. I don't know if that answers your question.
No, it does. And it makes sense. It's something we talk about all the time of like, to your point, we're in New York, we use third-party managers. Like, what is our competitive advantage a lot of times? That's why I would say 95% of the deals we've bought in the last 3 years, have not been your typical listed broker deal, because we feel if we can find something that's a little bit more creative or different, that's something that's at least some sort of a competitive advantage over the deal that, 99% of people see. But yeah, I mean, there's different layers to, how much you have in house and how much control you have and stuff like that. So I think it's a huge point, because I've seen too a trend recently of people that are in great areas to invest in deciding to invest out of state because they feel they can't get deals done. And I feel like there's been this growing trend since I've basically got into it, 4 or 5 years, of people wanting to invest out of state because it's sexy, or, there's the whole trend of live where you want, invest where you want. And that's totally fine. And I get it. I just worry sometimes that it goes too far to that one side and there's not enough emphasis of, hey, invest where you live or close by because you'll know it way better than living out of state. So it's really interesting to hear you bring up that point on your side of the coin.
When I always think about with you guys, especially that deal in Jacksonville, the contract slip that you guys found, which could not have been more off market, right? When we met in Orlando time, right? Like you guys are clearly, in the weeds on that market to know, particularly the guy that we were partnered with on that deal, to find him in that deal, right, is representative of the work that you can do, to find those deals in different markets.
Yeah.
No, I appreciate that.
But that was several years to get to that point. It wasn't, or a few years to get to that point. It wasn't like, picked up a phone, decided we're going to invest in Jacksonville, Florida, because that's a market we like. And, a day later we got an off-market deal that made sense. And that's, like you said, probably one of the more truly off-market deals that I think we've gotten. It's definitely up there. But yeah, it doesn't just happen. It took buying a deal that was basically listed. It took being in that market for a couple years. It took knowing somebody that, lives in that area as well as our manager, to really make that happen. So yeah, I think it's a really important part. And I think being in an area and being a good operator and having that system in place is more valuable than a lot of people give credit for. So I was really happy you said that.
And I talk about it all the time. I get the question, how do you pick a market? And then, some people say like, well, I live over here and I want to invest in Akron, Ohio because it's cheap. And I say, listen, that could be the reason why you want to do it. But judging by my experience, 6 months after buying because it's cheap, you're going to realize why it's cheap. And there's nothing wrong with Akron, Ohio and the deals that are there. But I tell people that is not the reason to buy something. You got to buy something because it's everything you want. And if it is out of state, make sure you like going there, because if you don't, you won't. Your property will suffer, because when you get a call from someone that lives in Raleigh or lives in Jacksonville or lives in these markets that are so good and they want to buy something, somewhere else, I say, go back to the drawing board there, because, knock on more doors in your backyard, because you will be significantly happier with that result. Also, when you find that deal, they always say, money finds good deals. When you find that deal, it's a lot easier to find money than when you knock on the door or you find the deal 250 miles away or 8,000 miles away, wherever it is. So no, I agree with both of you guys. The biggest challenge for me coming out of New York and doing everything in my backyard, even Philadelphia when I was driving back and forth, the biggest challenge for me going out of state was not knowing every single owner, every single block, the difference between this street and that street. And that was challenging, and you could overcome it by doing it. But I can't express the level of detail you need when you're going outside your backyard. So I don't think people talk about it enough, because I agree with Chris. The trend has been go online, find something on LoopNet, make an offer, buy it, operate it, sell it at a 3-point spread cap rate lower than you bought it for. You're going to make millions of dollars. And that trend is gone. So, maybe 7 years ago that was a good trend, but it's a lot harder today.
100%. I think that's an awesome place to wrap up.
Cap rates don't always just go down?
Well, that's how we underwrite. They just go down and down and down. Soon you're going to start selling, everything's going to sell at a 0.1 cap. It's crazy.
Awesome. Yeah, 100%. But like I was saying, I think that's an awesome place to wrap up. Billy, thank you so much for coming on, sharing your experiences, insights, knowledge, etc. If people want to learn more about you, connect with you, get in touch with you, where are some places to do that?
Sure. We have our website is partnerspath.com, PARTNERSPATH.com. You can shoot me email. I know I'm Billy Haddad, but it's W Haddad, HADDAD at partnerspath.com. Shoot me an email. I think one thing coming from investment banking, where a lot of it's just processing the deal flow that's coming in. Since I've been at Partners Path, it's tons of phone calls and conference calls, and it's a half hour here where you get to know somebody, and 12 months from now it turns into something. Mm-hmm. So I know we're always happy to have conversations with people and see where they're at, and if we can help if we can invest with them, that's perfect for both of us. And if it's us connecting them with someone who might be helpful to them, we're also happy to do that as well. So yeah, that's I guess the only real ways to get in touch with us. We don't have a podcast, unfortunately. We haven't gotten to that part yet.
Maybe one day. But beautiful. Guys, we'll drop that in the show notes. So if you want to go get in touch with them, you can find it there. Thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would be fantastic if you would do so. And if you are, please send it to a friend, family, or coworker that you think would get a ton of value of it. Billy, once again, thank you so much for coming on the podcast. This was fantastic. Thank you.
Thank you, guys.